So our next question comes from Nick A. Nick says, "Hey, Austin and Robert, my name's Nick, and I've been listening to your podcast religiously for the last 2 years. You guys have made such a huge impact on my financial education. I'm 34. I make $120,000 per year. I started my Roth IRA, and I've been maxing it out for the last couple of years. I also have a 401k that has about $30,000 in it and a bridge account with $15,000. I've been using strategies like strict budgeting and 0% interest rate credit cards to pay off high interest debt over the last year, and I've paid off $10,000 of high interest debt over the last 12 months. Nick, that's awesome. Love to hear it, man. We always tell people you can't outinvest high interest debt, and Nick is paying it off. Nick says we still have about $30,000 of car debt across our 2 cars and $20,000 in student loans, with some of those student loans above 6% interest. However, we have a plan to pay off this high interest debt quickly while leaving our low interest debt around so we can stay invested and grow our wealth. Here's the real question I have. We bought a house in 2021 at a 2.75% interest rate. Our family grew much faster than we expected, and to us, a good school district is very important. Currently, we live in a very bad school district in Nashville. We want to move to a different area and a bigger house in the next few years before our kids start school while maximizing all aspects of this move. What strategies do you have for us for making sure that we make the best decision possible given our 2.75% mortgage on our house? Robert, you want to kick this one off?
Yes, I think it's a great situation that Nick is in. Family's growing. That's awesome. Upscaling the house is great as well. The only thing I would consider, and the key part of the question was in a few years. I feel like what happens a lot of times when people say, we're going to buy a new house in a few years, they take their foot completely off the gas for all other strategies of investing for retirement and building wealth because they're solely focused on having money set aside for buying this bigger house. And I think that's a huge mistake and a lot of people make it. So in my opinion, and in this instance, I would really stay super focused because where a lot of people get things wrong is, let's say you're putting away for this new house and it's going to be more expensive. And you think you need $100,000 or $50,000 to go towards the down payment for said new house. It doesn't mean you can't still be investing that money over a time horizon of 2, 3, 4 years to maximize the gains you would make on that money, because you and I see this every day, Austin, where people are like, I have this money for the house in 5 years in this high yield savings or this CD that's barely making any money. That is a mistake. So I think as long as Nick and company make sure that they understand and have that time horizon figured out, that they can make the right play, because the other part of this is the 2.75% mortgage on the current house. That is really, really low. We might not see those rates again for many years, or if ever. So we have to take into consideration that as well. I know the school district is important, but don't plan so far ahead that you're giving up gains and growth in your financial situation right now.
I love this perspective, Robert. Here's my thing. You have an asset with this 2.75% mortgage rate. I mean, my goodness gracious, your monthly payment on that is probably less than $2,000. I mean, we literally just talked about this in a previous question where, they've got this triplex and the monthly payment on it was probably $1,500, $1,700. So Nick, I don't know what your monthly payment is. Obviously don't know what kind of house you're living in here. I would do everything I can to keep the house, use it as a rental, cash flow somehow, some way from that specific house, and then spend the next 2, 3, 4 years saving for a reasonably sized down payment to go buy a single family home in Franklin, Tennessee, which is Williamson County, voted #1 school district in Nashville. I'm on Zillow right now looking at a 4-bedroom, 3-bathroom house that is 2,400 square feet sitting on a 6,000 square foot lot that's listed for $600,000. I'm pretty positive that $600,000, again, I live in Nashville too, so that $600,000 is probably pretty close to the value of your own house right now. So like if you were to sell your home, I'm sure you could use the Section 121 exclusion to roll some profits into a down payment for the next one, but I'd hate to see you sell it. But just know that you can buy 4+ bedroom homes in Franklin, Tennessee for $500,000, $600,000, $700,000, which again, you live in Nashville, you've got money like that. You can definitely figure this out. I think there's a world where you can do both. You can keep it as a rental and you can go buy a home in the next 2, 3, 4, 5 years. Just make sure, to Robert's point, you're not forgetting about investing into the Roth, up to the match with the 401k. Like, don't turn off your investing to go focus on this. Do them simultaneously.
This really brings up a video I did, I think it was a TikTok 3 years ago, where I told people it was a bad investment to make their first real estate purchase a primary home. People came for me, but this really illustrates why I said it. So many people will save up for years to buy the primary home while not investing in their future, and then take all that money, dump it into the home. That money is tied up in that home till the day you sell it. And even if you do have capital appreciation and you love the home, you still have to consider you can't be house broke, and you shouldn't be house broke, because you have to plan for the future. So we just want to make sure everyone understands that. We love real estate. Austin and I both own real estate. I will always own real estate and buy more, but we just don't want people to sit on the sidelines because of a home purchase. I think it's a terrible strategy for building wealth.